Hello, good afternoon for people in South America, Central America, North America. Good evening for people in Western Europe. We are now beginning another international webinar of the Structuralist Development Macroeconomics Research Group. Today, we have the pleasure to have with us Lorenzo Nalin, and Giuliano Toshiro Yajima. Both we will present the webinar entitled Commodities Fluctuation, Cross-Border Flows and Financial Innovation, a Stock Flow Analysis. In order to present the authors, I would like to invite Professor Garcia Camenar, whom is the Vice President of the Regional Council of Economics of the state of Goiás. Cassia, how are you?
Hello. Ladies and gentlemen, good afternoon for those who are in Latin America and Caribbean, United States, and Canada. Good evening for those from European Union and Great Britain. My name is Kersia Preda Kamenashi. I am the Vice President of the Regional Council of Economics at the state of Goiás in Brazil. I will be the chair of this webinar of Structuralist Development Macroeconomic Research Group. Today we will have Giuliano Toshiro, PhD candidate from the University of Rome, and Lorenzo Nalin, PhD candidate from the National Autonomous University of Mexico, addressing the theme Global Finance and Peripheral Volatility from the lens of the SFC approach. These comments will be done by Professor José Luiz Oreiro, Associate Professor of Economics at University of Brasilia and the leader of our research group.
Okay, thanks, Cassia, for having presented our guests. So I think that we can start the presentation. Well, I don't know who will start first, but you can choose.
I will. So let me start sharing my monitor, please. Can you see it?
Yes, we are starting. Yes, now we are seeing. Thanks.
Great. So first of all, thank you. Sorry.
So just remember 40 to 45 minutes for both, right? And in order for you have to have some time for discussion.
Sure. First of all, thank you very much for the invitation. It's a great pleasure and honor to be here with all of you today and to present you some of our work, our concerns, and our ideas. And Giuliano and myself met a couple of years ago during the ECLAC summer school. And since then, we start working together on some project where we analyze the role of finance and its impact on the real activity for the Latin American region. So I guess today we have three main punchlines, three main ideas that we want to share with you. And the first one, quite simple, is that financial market and the financial sector has been growing exponentially in the region, while the real activity has been lagging behind. And we believe and we think, and we're going to show you that there are in the current macro financial environment some important concerns and some negative leakages from the financial sector to the real sector. And having understood those negative leakages, we will emphasize the importance of modeling the relationship between the financial and real variables to produce proper scenario analysis and to improve our macroeconomic, macrodynamic models. And we'll do it by showing 3 examples if we have time, but we can maybe skip a couple of examples due to a time restriction. So let me start with the easy style fact for the region. I guess you're pretty well aware of the fact that the Washington Consensus was an important structural change for the region, as after the negotiation for the debt restructuring, many Latin American countries liberalized trade, the financial sector, the banking sector, foreign direct investment law, and the interest rate market. So the fact that this led to the liberalization of the capital account and the start of an era that we can call financialization. And Latin American countries have been pretty successful.
Lorenzo, may I interrupt just a second?
Sure.
It would seem that your screen is black. Also, I'm checking on the YouTube Direct. It would seem that is your screen. Okay. Perhaps it's better if you leave it in. Yeah, now I can see it. We can see.
Okay, I apologize for the technical problem. So, but anyway, what I was saying is that the financial development in the region has grown. And if we take the 1980 as a starting point, we can see that all the 5 countries here reported have been progressively opening their financial market, deepening their financial market, and reaching higher level of development, financial development. So one would expect that this increase in financial development would be reflected in the rate of growth of the region, in the catching up process of the region, and in more investment, for example, due to the greater availability of capital and the greater integration with the international financial system. But if we look at data, if we look at data, for example, for the GDP growth, we see that in the aftermath of the Washington Consensus, actually the rate of growth of the region has been dropping from 5.5 to 2.85%. And if one concentrates just in the last decade, 2010, 2019, it dropped to 2%, which is really disappointing compared to what other low and middle income countries did, as they grew on average 5%. And the same is true for the catching up process, here calculated as differential in GDP per capita growth with high income countries. We can see that after the Washington Consensus, the only period where Latin America experienced a catching up process momentum was during the commodity boom period. And even though it was experiences this momentum, it was still lower than peers, and by peers, I'm referring to low and middle income countries. Also disappointing has been investment in terms of GDP. It has been falling in the last decade from 22 to 80% of GDP. And also here, the comparison with peers with other emerging markets and developing economies has been disappointing due to the fact that has diverged the trajectory of investment in the Latin American region compared to peers. So all in all, we have a growing financial market and lagging real variables. So here we have our second punchline. In our current macro financial environment, there are some concerns, there are some negative leakages that here we explain briefly, and then we show some data. So for example, an important role in the last decade has been given by the short-term portfolio allocation and its relationship with international financial crisis. And these short-term portfolios can create volatility in emerging assets in the region and can create or sell-off of the currency, for example. due to also the hierarchy of the currencies, which means that at the top of the hierarchy there is the USD dollars, and at the bottom there are those currencies from developing countries. And the currencies at the bottom clearly have higher liquidity premium. And in the current financialized environment, the currencies during financial turmoil are oversold as they were normal financial assets. And this has created a divergence between the value of the currency and the macroeconomic fundamental of the countries and the region. And also, this short-term capital has increased the level of indebtedness in the region and has contributed to create currency mismatches in the corporate non-financial sector. And finally, another dangerous feedback we have seen in recent times is the feedback from the currency depreciation to risk and the fiscal constraint, in the sense that when governments try to implement fiscal policies that are not liked by the market oversell local currencies, oversell local assets, increasing the risk premium and creating a financial constraint for the government. So I'm gonna show you some stylized facts to support our ideas. So as I was mentioned, portfolio flows are a source of volatility nowadays. And there's been a huge increase in portfolio flows. Let me start from the capital account. There has been a huge increase in portfolio flows due to the coexistence initially of a commodity boom since mid-2000, and then it was joined by the ultra-expansionary monetary policy put forward by the Federal Reserve and other main central banks from the developing world. And this created a huge inflows of both portfolio and direct investment. But we have to be careful with direct investment in the sense that nowadays most of them have a financial component, in the sense that they are merger and acquisition, and most of the time are also intercompany loans. So there has been a huge increase in financial flows from mid-2000 until the end of the commodity boom and the change in the monetary policies from the Federal Reserve. And this, and the end of the commodity boom and the taper tantrum created massive outflows in the region and volatility. And it goes along with the increase in financial flows that Latin America became the most indebted region in the world. But even most importantly, we skip this slide and go directly to what happened to the external debt in terms of both GDP and exports. So one of the problems for the Washington Consensus was the excess indebtedness of countries, and Latin American countries were successful in decreasing debt throughout the decades from the 80s to the beginning of the 2010. But then due to this low interest environment, international interest in low interest environment, there is a surge, a rise in the external debt, which is dangerous in the sense that the region went from having 25% of GDP in external debt issued in external currencies to nowadays a level of 55% of GDP, and it means 230% value of exports. And one of the sectors that increased in particular the level of debt was the non-financial sector, which starting from 2010 increased exponentially the issuance of external debt, especially in Mexico and in Chile. And this created a serious problem of mismatch. Mismatch refers to the fact that your liabilities issued in foreign currencies do not match your asset in foreign currencies. And of course, when you have a high level of mismatch, you're vulnerable to exchange rate depreciation. And if we look at the data calculated by BIS, actually from Chui, Kurok, and Turner, you can see that the region went from having almost 10% negative position in external currency in 2006, from having almost 40% of exports. And some countries as Mexico, Brazil, and Colombia increase a lot the level of mismatch between assets issued and liabilities issued in foreign currency. And another problem we have is the depreciation, the constantly depreciating pattern of the exchange rate. Here I report the nominal broad exchange rate, which is taken from the BIS. So in their calculation, a downward trend means depreciation, while an upward trend means appreciation. Here we see again, then when the Fed start tapering and when the oil prices fall, which marked the end of the commodity boom, we started a downward trend, which represents depreciation. So an important element that contributed to the depreciation of the currency is the financial engineering that has expanded throughout the last decade. And in particular, if we focus on foreign exchange over-the-counter derivative contracts, its daily turnover has booming exponentially since 2007, since the aftermath of the great financial crisis. So let's take, for example, Mexico, which was trading on daily average around 70 billions per day. It went in almost 3-4 years to a daily turnover of $32 billion in derivative contracts. And these contracts are traded most of the time outside the country, outside the region, and are traded in developed markets. And they are traded not because agents are interested in covering some commercial position, but rather they are used to speculate with the currency. And so when you see the decrease in the volume after 2013 is massive. For example, for the case of Mexico, that decreased by 12 billions per day. And on the left side of the slide, we report an important style aspect that motivated us to model the relationship between the Chilean pesos and future commodity index, and in particular, commodity linked notes. And if you see when the future commodity index drops after 2014, also there was an increase in the currency, which in this case, in this graph, means a depreciation. So short-term capital movements are also reflected in the high correlation between government risk premium, which is here proxied by the MB, and the nominal exchange rate. So most of the time you have co-movement in risk and exchange rate. And if you wonder from where the statistical causality runs from, we perform an exercise using vector autoregressive models and calculated the Granger causality. So 4 out of the 5 countries here studied, you see that the statistical causality runs from the nominal exchange rate to the MB. So when the exchange rate moves, there are also movement in the risk premium. And clearly, when the risk premium of the country moves, there is also a movement in the corporate risk premium. So all in all, we have portfolio flows that are constantly creating volatility in the currency. The currency impacts risk premiums. Risk premiums impact corporate risk, and this increase the interest paid by corporation. And to this framework, you have also to add the growing level of debt. So all in all, you have growing debt and growing interest rate, which poses a serious problem on balance sheet effect every time you experience a currency devaluation. So I will skip this part and go directly to why this matters for modeling. Well, here we describe a macro financial environment that is characterized with a great relevance of portfolio decision. We also describe an environment that in which financial stocks and financial flows are related and feedback to each other and impact the real sector. We also describe a financial market that increases in depth, and nowadays there's different type of agents. Some of those speculate with currency and assets, and they have greater risk aversion, and they might be different expectations from other agents. So here we have to take into consideration all this complex and evolving relationship between the financial and real sector. And we have to include them in our macro modeling because it's important to have models that are reflecting the growing complexity of the macro financial environment. So we think a great way to include these constantly feedbacks between real and financial variable are stock flow models, which are basically post-Keynesian macroeconometric models based on accounting framework and post-Keynesian theory. And there are three important elements, I would say, that distinguish this type of macro modeling with respect to other type of macro general equilibrium modeling. So one is the presence of the balance sheet, which takes account of the evolution of stock throughout time. This is important for accounting the level of debt that each sectors accumulate throughout time. And then you have the transaction flow matrix that takes into account the movement of flows between sector within an economy, but also between economies. And then finally, you have the behavioral equation of the model, which are based on, again, most of the time post-Keynesian theories. There are also, I would say, neo-Keynesian stock flow models, but the most majority of models are based on post-Keynesian theory. And we select this type of methodology, first of all, again, for its accuracy in measuring accounting relationship and to avoid the loss of flows and to constantly accounting how the movement of flows at the end of the day impacts the accumulation of stocks. And then because an important part of macro modeling through stock flow analysis is done by a portfolio approach literature, especially the one put forward by Tobin. And this is important, again, to take into account in a macro dynamic model the role of expectation and the role of preferences among assets. And then it's important also, an important characteristic of the model is the ability to address center-periphery asymmetries, which is really important to following the tradition of the structural economic school of thought. And finally, it also allows the departure from some conventional theories, for example, the uncovered interest parity condition, which has been found not to be not to hold in most of the cases, at least for Latin American countries. So rather than focusing on a lot of theoretical elements of the model, we decided to present some application we did of these models. And I will start from a model we are currently working on, Leonardo Roca Rodriguez from the University of Columbia and Esteban Perez Caldente from the Financing Development Unit at the ECLAC Regional Office of Santiago. And here we study the role of macro-prudential policies, and we try to create a baseline scenario to replicate the stylus fact that I so far presented. And then Giuliano is going to introduce some elements of a paper we did to take into account the role of commodity-linked notes, means financial engineering, on the swings of the exchange rate. And finally, we're going to talk about the balance sheet effects in Mexico. So let me start from the paper developed at ECLAC. Here, our objective is to modeling the relationship that goes from the international financial cycle, which is proxied by the international policy rate, on the demand of bond of local currencies, their impact of flows, portfolio flows, their impact on exchange rate, then MB, and then on expected profits and investment. So here we have what I was mentioning before, which is the transaction flow matrix that accounts all the movement between flows within sectors in economy. Here we decided to describe a small peripheral economy with three sectors, five financial assets, two bonds from the government, one in local currency and one in foreign currency, and the other two bonds are issued from the private domestic sector, again, local and foreign currency, and then you have a foreign bond, which is accumulated by the private and the public sector in the domestic economy as a form of reserves. And here you have an important role of the external, of the rest of the world, the external sector, in the sense that it can buy all the financial assets issued by the domestic economies and the domestic economy. So it has an influence on the demand of these bonds and then on their on the value and the currency and so on. So what we model here is the real sector governed by the Tier 1 law in the trade sector. There is no full employment, wages depends on productivity. An important novelty of the model is the expansion of the work from Lavoie and Daigle, in the sense that the exchange rate in the model depends on expectation, but also market composition. We have two types of investor. One is a more speculative investor, which we call chartist, in the sense that it follows technical analysis, and the other investor is has less aggressiveness and follows a fundamental value of the exchange rate. And then we also introduce as a novelty for the stock flow modeling the role of the figure of MB and SEMB, which depend the MB on domestic debt and exchange rate movement, while the SEMB depends on MB plus a currency mismatch. So we have also a role of the SEMB risk premium on the spread for government interest rate, but also a role of supply and demand of bond, in the sense that if the model experience excess demand for asset, there will be an appreciation of, there will be a reduction in the interest rate, and corporate rates depend on SEMB, and the demand for asset is governed by the rule of arbitrage, and there is a possibility to repay each sector. And finally, here we wanted to emphasize the fact that investment not only depends on expected profits, but also on investment confidence, which in turn is a function of financial variable and output growth. And just to show a little bit, I promise I'm going to be brief, just to avoid too many formulas. Just the MB, which I was mentioned before, is a function of the ratio of debt over GDP, but also of the second element is the external debt over international reserves, and the third element is the variation in the exchange rate. And the SEMB is a function of all the above, plus the mismatch, which here is calculated by the ratio between the foreign debt of the private sector over the reserve they accumulated. On the right side, you have the exchange rate, which, as I was mentioned before, is a function of two types of agents. One agent looks at the MB as well as the misalignment of the current value of the currency from a target value that depends on macroeconomic fundamentals, while the more speculative agent focuses on the variation of MB, but also it follows the trend in the current value of the exchange rate. And then you have investment, which depends on an investment confidence index, and the index in turn depends on PE, which is the expected profit, plus the real activity, which is given by the Y arrow, the rest of the world, which is the variation in the GDP world. But here is important to see that expected profit, the third line on the left side of the screen, the expected profit depends on ROI, which is basically calculated as benefits over investment, return on investment, and the SEMB. So SEMB is a function of all those financial elements. So here we have the implicitly we have that the investment not only depends on real variable, but also by financial variable, by expectation, and by the level of debt. And on the right side, we model the demand for asset as a form of arbitrage. And you can see in the second line that agent demand bond issued by the government sector by looking at the yield of the bond, IG, and the expected return on real investment according to some sensitivity parameter, sigma. So here we have a fiscal rule we are going to test, but it's not relevant for now. So the ability of these models, when you take into consideration all the leakages you have from financial and the real sector, is to predict quite properly, I would say, for some important variables such as GDP growth. And here we perform an exercise by using real observed data for the 1 year nominal interest rate and the world GDP growth. And here you can see that our estimated domestic growth kind of resemble the observed GDP growth performance over the period from the 70s to there is a forecast to the 30, but nowadays I would say. And the model here, the model has endogenous interest rate. I apologize for a mistake in the graph. The blue line should be the interest rate in dollars, while the red line should be the interest rate in local currency. The legend is inverted, but what we can see here is that the endogenous modeling of the interest rate shows a decreasing path throughout times that also resemble what happened in real life. And along with the decrease in interest rate, we've seen an increase in the private debt as percentage of GDP. And if you focus on the red line on the right, you can see there is a spike after 2008 when there is a drop in the international interest rate. So again, considering all the macro financial leakages, we can provide an accurate image of reality. And if we calculate the mismatch index, clearly is going to deteriorate throughout time in the sense that the value of foreign liabilities over foreign assets are growing, and the value of foreign assets is growing faster than the foreign liabilities is growing faster than foreign assets. And this implies that you lose net worth in the private sector. And clearly, when you have when you lose net worth, you increase the mismatch, and you have a growing debt. What you are paying are more interest, and what you are doing is reducing your profits. And here, this simulation shows that within framework, profits are volatile and shows a cyclical increasing pattern. And this is the same for the expected benefit. So all in all, we have a stagnation of investment, of private investment over GDP. And this is particularly true after the 2020. If you look at the trend, the red line on the left side of the graph. And here there are some discrepancy with real life data, but because unfortunately we didn't find data for the private sector investment for Latin America as a whole. So I use the investment, the total investment, which I think is biased by the fact that government investment has been declining over the past 10 years. And also the model properly captures the relationship, the volatility in the current account, and also resemble what has been the observed data. And also the model captures the volatility we have seen in the exchange rate and the risk premium for the episode of the 2010 financial crisis and the 2020 COVID crisis. And finally, what the model tells us is that we have volatile sales, but even more important, we have a consumption that is constantly adjusting, that is volatile as well. And this is done because in the model, the consumption is also influenced by the net inflows that the economy is experiencing. So here we wanted to introduce some sort of miskin element in our system, and this implies that the output is a volatile consumption starting from 2010. As we saw, the volume of net inflows have grown exponentially. So I would not, I would let Giuliano continue to present some other work. I guess we still have time, I hope, and Thank you for the attention so far. Shall I stop sharing, right, Giuliano?
Yeah, I will start sharing my screen.
Okay.
Even though the presentation is pretty much the same. So just a sec. Okay. Okay. Can you see my screen?
Yes.
Okay. So, well, many thanks, Lorenzo, and thanks, Professor Rego, for the opportunity you've given us today to present our work. Well, as Lorenzo was saying, I will present in particular two models that we developed together with my colleague. Well, differently from the one that that Lorenzo showcased in the last slides, these are more well, theoretical exercise. Even though we did run some we did run some validation. We did use some validation technique in order to check if the series generated to our simulation were capable to capture some of the trend that the model was performing. And at the same time, we also perform some estimation of the key parameters. Well, going particular to this model, the one that also Professor Orego mentioned at the very beginning of the introduction, was published at the first quarter of this year in Metroeconomica, and was partly inspired by the case of Chile. Why? Because Chile has a long history of speculative attacks and balance of payment prices. And in particular, at the very beginning of the 2000s, with the rising commodity prices environment, foreign investors shifted part of their portfolio composition towards toward the developing country security, in particular Latin American and also the Chilean ones, in search of short-term capital gains. And as also Lorenzo showcased at the beginning of the presentation, now financialization has allowed those international investors to have a wider range of financial instruments in which to invest. Some example may be derivatives or the ATS, or in general structured notes. We did use from the open the so-called open flex with the model, which is a framework put forward by Winnie Godley in well, at the very beginning of the 19th, when we moved from the UK to the US, and we started working as a visiting scholar at the Levy Institute in New York. And then he put forward in particular is this two country model, where he was interested in trying to model in particular the dynamics, and the price formation dynamics. It influenced the nominal and hence the real exchange rate. So we started from this framework, and we slightly modifying in order to also to match the characteristic of the Chilean economy. So we have this. Our model presents, as I said, two economy. It's a two economy model with each of this economy has five sectors, namely household, the production sector, the government, and the financial sector, and the central bank. The financial sector actually was not present in the original framework of Godley, and was not even present in the model that was later published in 2000 in the famous 2006 monetary economics book by Winnie Godley and Marc Lavoie. And we in this model we also each of these economy has four assets, namely money, bills issued by the government, the deposits issued by the financial sector, and this structured note and deposit and structured note, which are both issued by the financial sector. We do have homogeneous household in the sense that they both receive both wages, income from wages and profits. In particular, these are financial sector profits, and they also receive income from the asset from the yields of the asset that they in their portfolio, and and also U.S. bills, in particular, are used as international international reserve. And there is an asymmetry here because since the U.S. plays since the U.S. dollar is played an important role in the sense that they are the ultimate reserve currency. We decided to model it as the only asset that is really really available to the Chilean central bank in order to balance their account. Finally, we do model a flexible exchange rate. Whilst in some of the model of the Godley-Lavoie book, there is also a fixed exchange rate closure, but we prefer to model it a flexible exchange because we think it is capture more properly the stylized fact of the economy nowadays. So this model, very briefly, it will be really interesting to make a standalone seminar on this model. But since we don't have time, I will try to I will try to give a very brief showcase of the structure of this model. And particularly, Winnie Godley in a paper which was actually never published, but is it is basically a internal paper of De Levi. Try to describe it to the audience, which was presumably the students of the Levi Institute, and he presented as and he said that the model can actually be split into four separate submodels, which is a Tobinian model of asset demand and supply, which focus on the financial determinants of the nominal exchange rate, and a Caldorian model of trade flows, both at constant and current prices. And there is a standard Keynesian model of output, income, and wealth determination. And finally, there is a Kalecka model of cost, prices, and distribution of income. To this framework, we had some modification, and in particular, this may be thought: how do we, in particular, model the linkages between the prices for the commodity prices and the financial sector through these devices, in particular through this equation, in which we assume that the price of the structured notes that we were mainly interested in depend on the natural logarithm of the export prices, which may be thought which may be thought as a way to introduce the trend of the commodity market in a financial asset, in the dynamic of a financial asset. And of course, as I mentioned you before, there is a model this Caldorian model of the determination of trade flows, which is I would say very standard. I mean, you surely, if you have some experience in particular with the study of the theory law, you will immediately recognize its basic structure. The only feature here that Godley distinguish also between export and import prices, which also allowed him to consider the terms of trade dynamics. And as I mentioned you before, we also have this the Tobin model, the general structure of the Tobin model, the portfolio choice model, which was put forward in the late 60s, beginning of the 70s at Yale. In particular, we also added a twist. And there will be the equation, the portfolio demand for the U.S. residents, just to be clear. And we also add this twist to this portfolio model by including the dynamics of the prices of these structured notes, and in particular the change in the price in those prices, and that will definitely influence the yields and raise the portfolio and raise the allocation the portfolio toward and shift the portfolio allocation towards this asset. And again, and how do we connect this to the portfolio to the nominal exchange rate? The Godley model and also our model really defines the nominal exchange rate as I will show you briefly here as the demand for Chilean asset over the supply. So in the sense they capture the exchange rate, that is the exchange rate formation that take place at the banking level, one can say. So in order to explicit this link, we also had this equation toward which we connect the demand for the Chilean asset issued to the rest of the world residents as to the stock of the structural notes supplied to the rest of the world residents, which again is meant to capture the exposure of Chilean intermediate. Well, actually, will be rest of the world intermediaries when issuing these notes. And again, this creates an explicit link with to the definition of the exchange rate that I provide you in this equation. And again, there will be the block of the financial sector of the rest of the world, but I will shift and I will and this also capture this securitization process from the basically we will have something that I also mentioned you before. So we run the following simulation. So we run the model for 110 periods, 110 periods, and we perform two shocks. We firstly increase in the exogenous demand for exports, and then we decrease it by well by twice the amount of the first shock. Why? Also to capture some of the stylized fact that the region Chile experienced at the end of the commodity boom. As you can see from the results on the simulation, I mean, this is a there is a in particular. I just want to focus you on this on the current account on the result at the current account, because that will be the blue line at the very at the very beginning of the. At the beginning of the simulation, there is a shock. There is a positive shock which creates a spike at a spike at the peak when after 3 periods the model has gone through this the simulation, and then the model slowly converges towards a long run steady state. But then this convergence is interrupted when the second shock is introduced, and at the city at the city state, the current account, differently from the baseline model of Godley-Lavoie, doesn't converge towards zero, but it remains but it remains slightly in a slight negative position. This is because of the increase interest payment on foreign debt in particular. In fact, if you can see there that the ratio of the external to total government debt has rise increasing the double, well, not double actually, but is after a drop at the beginning when there is the upward phase of the cycle, actually do increase and do converge to an higher steady state. While there is also an increase in government debt, and there is also a loss of net wealth for the Chilean economy as a whole. And obviously the real exchange rate ends up more devaluated after this after the whole experiment. We also validated. We very briefly validated the model by performing output autocorrelation and auto and cross correlation. Particularly, we with the actual and the simulated series. In particular, we also performed the cross correlation between the output and consumption, and both with the actual and simulated data. And the model, as you can see, matched quite well at a very reasonable level, at a very reasonable degree, the real data. And we perform also several sensitivity analysis. For space reason, I won't go into this, but you can also check it. But you can sure check it. The model that again has been published in Metaeconomica. And the second model is currently under review, and yet has been also published a first draft has been published as a working paper for the Levy Institute, and just very briefly to this. Well, actually, this model is resemble quite a the general structure is very close to the one of the one I just described you, with with the relevant exception that we do model also also the firm's accumulation decisions. So again, and we also change our our country. Now we were more focused in Mexico in particular, and we were also trying to assess together with the general problem of this the rise of this complex financial instruments, and the problem that also, and the other side of the other side of the money of the of this problem for developing countries, that is the rise, the emergence of the balance sheet effect due to an increase in the external debt, in particular in the non-financial corporate sector. And as I said, the model was inspired by the case of Mexico this time. And again, as I say, really the new element is the Rhodian accelerator model, and also we add also, and we also add obviously another asset, that is the capital stock, and the two capital stock of the two countries, namely, actually, and the securities issued by the corporate sector, which again will play a relevant, a very important model for role in our model, because, as I said, the novelty in this exercise consists in the issuance of these corporate securities sold abroad by Mexican firms. Again, because when profits do not enter in our model, when profits do not cover all the financial needs, well, the firms can rely on two types of external funding. That is, the domestic loans provided by the local banks, rather than, well, there is a mistake here. We will be local banks rather than national one. And the foreign debt, again, issued to foreign financial intermediaries. And this demand for domestic loans is characterized by an exogenous component plus an endogenous one, which is determined by the interest rate differentials. And then comes one of the other novelty of our model, because when there is also a mistake here, where there will be the other way around. When the financial condition in Mexico are tighter than the one in the US, then firms will also issue the endogenous part of debt in local currency. No, okay, so it's sorry, it's the other way around. Okay, so, well, the mechanism again is the same. When the financial conditions are tighter in Mexico, all the financial needs will be covered by foreign debt, and the other way around. And sorry for the confusing explanation. So again, there will be the structure of the model covering this, as I said, this Rhodian part. But we also add, thanks to a suggestion from one of the review, a Minskian twist to the model. Well, let me say this: this model is well, how do we model this twist? Well, we relate the behavior of we endogenize actually the capital output ratio, and we explicitly make it dependent to the debt to capital ratio, which represent the net value of the firm calculated as the inverse as the total stock of debt over physical capital. So what will be what will happen? So if there is if debt increase, surely when there is an expansionary phases of the cycle, debt firm investment will rise, and as well as debt. However, as soon as the economy experiences a financial turmoil, the nominal exchange rate will depreciate, interest paid on foreign debt will raise, and liquidity will dry, putting downward pressure on the investment target, and thus capital accumulation. You can see the mechanism is captured by equation 10 and 11, as you can see. And of course, this twist on the target capital output ratio actually makes the leveraging process even worse from a certain point of view. And this will end up in a, and as we'll show you in a moment, will end up in a, and will provoke some will provoke some we have some feedback on the economy as a whole. So the simulation again is really close to the one that we also performed with the first model, but this time we also model the change in the shift in the stance of the monetary authority and thus of the financial condition, the international financial condition. And we also model it as a to also kick off this twist that we set in the equations. And as you can see now, and there is also another element that I failed to mention. Recall that in the first model we were trying to capture the we did move the price, the autonomous component of export prices, and at the second shock was we performed the second shock, the downward the negative one, with a value that was twice the value of the initial shock, of the initial positive shock. In this case, we did model a asymmetric shock. That is, we simply impose an acceleration because again those autonomous components are modeled as logarithm, so can be assumed and can be thought as an acceleration of prices, of export prices. So we did model this acceleration, and then after the end of the commodity, we simply return it to the original level. And still, we obtained an important result, that is this long downward trend on the external pricing, namely on external prices, namely the real exchange rate and the terms of trade, and also the price of the structured note. And as you can see, investment do follow a Minsky-like dynamics. Well, you experience in particular when we look at the investment figure, because there is an initial spike which slowly comes down, and then there is a huge drop which unfortunately does not converge to the original level. The figures are all in standard deviation. So, and this trend is even more compelling for the capital stock. And here it experiences even more. There is an even more clear picture of the balance sheet effect for the model. And of course, as you can see, there is an explosion of the debt of the non-financial sector, non-financial private sector. And we also validate the model this time with we also perform the same exercise for exports and consumption, and also investment. And we also obtain a fair we believe that we also obtain a fair representation of the reality in terms of a comparison with real world data. And we deeply perform also a sensitivity analysis, but I think I'm running out of time, so I will jump to the conclusions. So in general, for us, for our say, for the research items that we have been publishing in the last 2 years, and so it's really a conclusion of our a wrap up of all our our exercises, but also of the discussion that we had in this in these 2 years. Really, financial matters matter in the long run. So, and if we, for instance, when and you can see this where when we compare to the when we look at the simulation in the OpenFlex model, the external balances ended up in a lower position, and in particular, the current account scores a deficit position. Again, due to the increase in interest payment on the foreign owned debt. And this is true for both the models, because I didn't have time to show you for the model of Mexico, but it's also the case that we did have with the steady state, the long run, the steady state position of the sectoral balances and the external balances is really a deficit one. And in particular, the model replicates the J dynamic, the famous J dynamics for the nominal exchange rate and also for the terms of trade. Because you can see that either they first appreciate and then slowly depreciate, stabilizing to a new and more devalued level than the baseline. And notably, household wealth and consumption tend to be lower. And this implies a transfer of wealth taking place from the commodity-led country towards the financial center, and on the other hand, major reliance of the, again, commodity-led country upon export performance, and which may cause again reinforce the vulnerability of the country. And again, one important element for the business cycle is financing. And in the long run, these imbalances could emerge, and currency undervaluation might have an adverse effect on firm net worth, as also argued by mainstream authors like Bernanke and Gertler and Gillis, for instance, but also again by Hyman Minsky. And we believe that also are in line with most of the structuralist literature, which argues that really the external, the problem with the external imbalances is really a private sector-led one. And for instance, because as you can see, as we have seen, when depreciation materializes, firms do suffer a reduction in profitability as unit cost per sales decreases due to the presence of both imported inputs and foreign denominated liabilities in their balance sheets. Very briefly, our two final points. Well, the Poncinator really also all the exercise that we perform really shows the Poncinator of the external financing. This in particular is a concept put forward in a paper which unfortunately I couldn't recall, by Jan Kregel, who really was pointing out that when a country in general relies upon external financing, is really as if it's was really carrying out a kind of Ponzi scheme, Ponzi scheme at the macroeconomic level, and this also points toward the need to find alternative way of financing to avoid the financial volatility and the constraint imposed by international market-oriented instruments. And finally, the long-run effect of macroprudential policies. We do argue and we do believe that quantitative control, in particular capital management, may play a role to avoid short-term capital flows, promoting at the same time the long-term capital accumulation. So I will stop here, and these are our contacts. And thank you for the patience. And sorry if I've been longer than my colleague. So I will stop sharing my screen.
Okay. Well, many thanks to you, Lorenzo, and to you, Giuliano. Now I'm supposed to do some comments on the presentation. Well, I think that your presentation is a little broader than the paper you sent to me. You sent a paper that you have published last year in the Macroeconomica, which is called the Commodity Fluctuations Cross-Border Flows and Financial Innovation and Stock Flow Analysis. So my comments will be centered on the article. I think you presented a lot of information, and I simply can't assimilate all the information that you presented in your webinar. Okay, well, you are in your paper. You presented a really interesting issue. Is about the commodity boom or the fluctuations in commodity prices and how it affects the real side of the economy. And I think that is a real interesting issue for us in Latin America. So the relevance of the paper is evident. But I have some comments, specific comments on your model that I will make now. Well, the first comment is regarding the equation 1, the price and equation for the current commodity linked notes. I understand that the commodity linked notes are essential for the mechanics of your model, because it's through the commodity linked notes that the boom in commodity prices had financial consequences, have consequences as overvaluation of the nominal exchange rate, you have capital gains, have a lot of wealth redistribution between the center and the periphery economy. I think that's the mechanism for your model. But I'm not convinced about the logic of the price equation, because the first term, if you look to the first term on the right side of the equation, is basically the pricing of perpetuity. I give this on my courses on macroeconomics 1. If you have a perpetuity, the current price of a perpetuity that pays one monetary unit as cash flow for units of time until the end of the world, then the price of the security, of the perpetuity, will be 1 divided by the interest rate. Okay, that I cannot understand this pricing. What I can't understand is why the price of the exports is doing in this equation. I can't see how this equation came from an arbitrage operation between domestic bills and other sides of assets. I think that it is an ad hoc equation. So, and that is a problem because it's your main equation. Yeah, all the entire conclusions that you have on this paper depends on the correctness of this price equation. I am not convinced that I can derive this price equation for the commodity linked notes by arbitrage operations. That's the first question. The second, first observation. The second observation is that in the financial modeling, you are supposing that the financial intermediaries of the rest of the world buys essentially government bonds on the Chilean economy, and for some magic that is not explained in the model, it's made a process of securitization with another asset that are not in the model, that is supposed to be linked with the commodity prices. And this process of securitization, from this process of securitization, emerge this commodity linked note. For me, it's not clear. There is a black box here, because you are essentially the financial intermediaries of the rest of the world is just buying government bonds from emerging economy. How can you transform a government bond for an emerging economy in a commodity linked note? You have to hand another asset in order to do that. Sectorization is exactly this. It's pooling many types of assets in order to have another one which is supposed to be more liquid and with a lower risk than the original assets. That's what sectorization means. So for me, it's not clear. There's a black box. There is some kind of magic that occurs in the financial sector of the rest of the world that it allowed it to transform government bonds that has nothing to do with commodity prices of commodities in external markets, in an asset which current market price depends on the price of exports. So this is a black box in the model. I'm not convinced about the story, and I think that you have to give a more clear and detailed explanation of how this process occurs. Okay. So this my first observations regarding the model. Well, you are assuming that the Chilean economy is a primary export. You say that on page 13, where you assume that the income elasticity of exports is 0.8 and the income elasticity of exports is 1.2, which means that the ratio between income elasticity of exports and imports are 0.67, so lower than 1, which means that in the long run, by the Theo's model, the Chilean economy will fall in behind the rest of the world. Okay. But as I understand the equations, well, the model is very large. It had 93 equations, as I counted it. All right. But the model is not a growth model. Is a model that determines the level of current income, basically. So, all right. I think that will be more interesting, a growth model. I think that you make very interesting formalization of the financial side of the economy, but the real side of the economy is basically very simple. It's a standard Keynesian model. where the output is demand determined. As I understood, there is no investment since there is no fixed capital. That's why the consumption GDP peaks almost 90% on your simulation, baseline simulation. It's too high. There is no consumption share in GDP that changes between countries, but it can be 50% in China and maybe 70% in Brazil. But I think that there is it's unreasonable to have a consumption share in GDP higher than 75%. If you have a consumption share of 90%, it's too much. But I think that will be interesting to include physical capital in the model and to work the real side of the economy as a growth model. Because if you want to include the structuralist dimension in the model, we have to make a growth model, not a model for a short-term model, a model for the determination of the level of employment and output. All right. Okay. Well, the model produced some weird results. In page 17, you show that in the simulation, the external sector is benefited after the end of the commodity boom. Because when you gave a trade shock, a shock on the terms of trade, first you have an exchange rate overvaluation and appreciation of a nominal and real exchange rate, and then after, when the commodity boom ends, you reverse it, but the nominal and real exchange rate is ends at the low level, or is lower than was in the beginning. So for the tradable sector, the end of commodities boom is good, because the nominal and the real exchange rate are more competitive after the end of commodity boom than it was before the beginning of the commodity boom. And this result I do not accept. Well, mainly, take for instance the case of Brazil, right? We had a commodity boom from 2003 to 2015, mainly, right? During the commodity boom, we saw the share of the manufacturing industry in GDP reducing and reducing. In 2005, the share of a manufacturing industry was more or less 18% of GDP. At the end of the commodity boom in 2015 was 12% of GDP. And yes, and at the beginning of the commodity boom, the real exchange rate were much more depreciated than it was after the end of the commodity boom. So I think that the problem with this result is that in your model, there is no structural change. You can have a wide and persistent fluctuation in the level of real exchange rate that will change no parameter at all in your model, basically and fundamentally the income elasticities of imports and exports. That's here I strongly disagree. Because when you had a persistent appreciation of real exchange rate, this will change the structure of the economy. This will lead premature deindustrialization, and premature deindustrialization will increase the income elasticity of imports and reduce the income elasticity of exports. This means that the balance of payments constrained growth rate will be lower after the process of after the end of commodity boom than it was in the beginning of the commodity boom. So the country after the end of the commodity boom will be growing at a lower pace than it was growing at the beginning of the commodity boom. I saw this very clear in Brazil. We had from 1995 to 2002, the Brazilian economy grew at an average rate of 2.5% per year. During the commodity boom, it accelerates its growth rates to more or less 3.5% per year. Then, in 2014, we begin a great recession. The recession ends at the last quarter of 2016, but then the average growth rate of Brazilian economy from 2017 to 2019 was just 1.3% per year. So that is more or less the half of the trend growth before the commodity boom. So I think that the great hysteresis problem of a commodity boom is the long-lasting effect it has over the structure of production. And this is not modeled here. It can be done, but in a simple way, I think. I know that these models, the stock and flow consistent models, are when you introduce a little another sector or another asset, it increases the complexity of the system too much. I know that, and I'm not completely convinced that the questions that are relevant for structuralist development macroeconomics can be modeled by stock and flow models, because the models will be so complex that maybe they will be untractable. But on your model, you can introduce a feedback mechanism from the real exchange rate to the income elasticities of exports and imports. Since, for instance, you can introduce an equation that says that if the ratio between income elasticities of imports and exports depends on the moving average of the real exchange rate, with some time delay. You can introduce a time delay, for instance, 2 or 3 years, but it depends on the moving average of a real exchange rate. So when you start the commodity boom, there is no effect, there is no immediate effect over the ratio of income elasticities, but after some time, the appreciation of real exchange rate will start a process of a structural change, and this will reduce the ratio of income elasticities of exports and imports, and then it will reduce the growth rate of exports, which means that will reduce the growth rate of autonomous, non-capacity autonomous demand, and this will this will result in a lower rate of economic growth after the end of the commodity boom than relative to what occurs at the beginning of the commodity boom. I think that is one mechanism that I have to think. And my final question is, in your conclusions, at the end of your conclusions, you say, From a development policy perspective, the stability of the currency is a crucial element for a small peripheral country. Thus, in order to minimize exchange rate volatility, foreign exchange interventions by the central bank are necessary but not sufficient tools and should be coupled with stricter regulations on cross-border financial flows and actors. Well, I have two observations. I completely agree that excess volatility of nominal exchange rate is bad, because volatility means uncertainty. And if you increase volatility, you are increasing uncertainty, and an increase in uncertainty means a reduction in investment. So I might completely agree that the exchange rate policy should be designed in order to stabilize the nominal and real exchange rate. But the problem, though, the issue is not only to stabilize the nominal and real exchange rate, but what level the stabilization will be done. Because in Brazil, for instance, from 1995 to 1998, we have a very stable nominal and real exchange rate, but at an overvalued level. And this created a current account problem. In 1993, Brazil had a small surplus on current account and balance of payments. In 1998, it has a huge deficit in current account of more or less 4.5% of GDP, what is unsustainable and produces a balance of payment crisis at the end of 1998 and beginning of 1999. So the problem is not just to reduce the volatility, but to manage the exchange rate in order that small fluctuations occurs at the competitive level of the real exchange rate. That's the point. That's the problem. Because if you have overvalued exchange rate, this will produce premature deindustrialization. Premature deindustrialization will change the income elasticities of imports and exports, and this will reduce the growth that is compatible with the balance of payments equilibrium. So it will reduce long-term growth. So, well, what are the policies that government, the central bank, can have to stabilize the exchange rate? This you can do in your model, is introducing some type of capital controls. In this, there is a very simple experiment that you can do. It's just to introduce a tax over the sales of domestic assets for foreign investors. And then you can run this experiment. Suppose that when and if a positive shock on the terms of trade occurs, the central bank counteracts, increasing the tax over the sales of domestic assets for foreign financial investors. I believe that if correctly fine-tuned, you can sterilize the effect of the shock in the terms of trade over the financial side of the economy, and you will no more have a commodity, the commodity boom will have no effect over the economy. I think that is a very simple experiment that can be performed with this model. Just introduce a little change in the structure, and you can perform this exercise and analyze if the capital controls can in theory be effective or not. There is another issue about if it's possible for the financial sector to overcome the capital controls. This is another story, but in theory, you can introduce this kind of capital control and see what is the effect over the financial flows between the Chilean economy and the rest of the world. Well, this is my comments. Before we have two questions for the audience, but before the questions of the audience, I would like to hear your comments on my comments.
May I start?
For sure.
Okay. So thanks for all those comments. They're really useful, and there's a lot to think about what you said and concerning our model. But so I will start from the point of real exchange rate and the disindustrialization. I completely agree with what you mentioned, but I guess the objective of our paper was much simpler than evaluating the whole effect of the exchange rate on elasticities and on the industry. Actually, we wanted to start from the simple stylus fact that due to capital flows and financial engineering, you have constant volatility in the exchange rate, and at the end of some kind of bonanza, you ended up with a much devaluated currency compared to the starting point. So that, and then you have a lot of volatility in the capital account. So that was the objective, which is, I think, much simple than what you mentioned. Of course, what you mentioned is relevant, and our model lacks that kind of.
May I just make a remark?
Sure.
In your model, since the real exchange rate after the commodity boom is more devaluated, and you are supposing that the Marshall-Lerner condition is accomplished, then the level of output is higher after the commodity boom than before the beginning of the commodity boom. If that is so, then the level of employment is higher at the end of the commodity boom than compared to the beginning of the commodity boom. What I'm saying to you that an important aspect of the commodity boom you are losing with this argument, because if you are a worker, well, maybe Chilean capitalists had lost some of their financial wealth, and what's the problem? Better, worse for them. But if you are a worker, maybe you were unemployed before the commodity boom. Now you're employed after the end of the commodity boom. Maybe and if you are still employed before, now you can have higher wages. It depends. I don't know. I think that the problem with the commodity booms is not only on the financial side, is the devastation that it makes over the real side of the economy. That's the point. That this link between financial variables and real variables we are losing if you do not tell this story. Because when I saw the simulations, well, I think, well, the end of commodity boom is not so bad. If you are only worried about the level of employment and output, the country will be in a better position than it was at the beginning of the story. Some capitalists, domestic capitalists, lost financial wealth. Who cares? It's their problem. But the country is in a better position. It is with a larger level of output and, for sure, a larger level of employment. So, what the country lost? That's
no. I agree. I understood your point, and it's more than correct. Maybe the goal of the paper was not that ambitious of evaluating the whole story in a commodity boom, and was just about currency swings, which makes just half of the story told and the other half of the story not told. And that's for sure, there is for sure a room to improve the paper. And thank you for those comments. And also about the price influence, about the price, sorry, of the commodity link notes. You at the end of the day, you're linking the price with the exports, so you are having a price that is working in the Tobin portfolio equation. So there is some kind of arbitrage and decision by investors in searching higher yields and then buying more commodity linked notes because they're paying more. They pay you a higher price.
But
yeah.
you can write just in a footnote how the price of how you arrive at the price of the equation now, the price of these notes, because I simply can't do that. Okay. Because when you are talking about the pricing of perpetuities, I do the exercise. I know, well, this securities has this cash flow until the end of the world is $1 per year. So the interest rate is R. So the price is the present value of the cash flow, which is infinite. So I can calculate precisely the price of the perpetuities, but I can't understand the pricing of this commodity linked notes. So or can do it in a footnote or in a annex to the paper, but just showing how the price is determined. I think that's important.
Okay, perfect. I understand the concern, and it's something that we have to add. And then the securitization, I agree, it's simple. Actually, we're just saying that a part of our bills are transformed into commodity linked notes. But as you were mentioning before, when you add a lot of equation and a lot of assets, the model can explode. So we had to keep things simple in that side, and assuming that a proportion, maybe it's a magic box, maybe it's just fake, but the point is when you create this, when you have this type of asset in the system, independently of which is the specific mechanism, but when you introduce in the financial system those assets that are so cyclical, that's a problem for your currency and for the stability. That was the exercise of having the securitization process, which is not fully disclosed, as you were saying before. And then about the experiment on taxes, yes, it's something that we are thinking about a further development of the model with some experiment from a policy recommendation perspective. And for sure, tax on sales, it's something that already happened in reality and could be replicated also in the model.
Giuliano, you have something to say?
Yeah, just to complement again, sorry, I think I did have some connectivity issue through your discussion, so I may have missed a couple of points from you. So apologize if I won't probably say something that you already stated. Well, anyway, just to complement some of the Lorenzo point. Well, we completely agree with you because the exercise lack. Well, you spot some of the issues of the model, and again, as Lorenzo said, we were trying to address or a kind of different research question, even though at a certain point of the paper we did also venture in some field in a field in which probably we would have needed a different tool. And now we are trying to complement this model with the one that we unfortunately we did present it here, and we were really happy to share with you the working paper format, because I think it's trying to going towards the direction that you pointed to us, that is to model explicitly the firm's decision to accumulate, and to try to say something about the manufacturing sector and his and general the process of regressive structural change that took places in the aftermath of the commodity boom. And for instance, it also may we also thought I also thought at a certain point of time to model also the long run effect, the very well known long run effect, which is also been pointed, which also has been argued by many new structuralist authors, structuralism, structurally also of the exchange rate over the income elasticity ratio. Um, I think that this could is not very. I mean, it is a one device could be the one that you mentioned to us. Um, because we also thought I personally also thought to relating directly toward the dynamic of the manufacturing sector. So will be maybe a function relating explicitly towards the labor productivity, for instance, or some technological parameter which is endogenous in the model. And I think that probably will create even well, okay, together with the external price effect, there will be also some kind of quantitative effect in order to try to take into account also the technological aspect, which is also crucial in the structuralist tradition. So I don't know what you think and what may be your thoughts on this, and yeah, and also finally on the again on the two in particular on the two difficulties that you spot in this version of the model, namely the prices the prices of the perpetuity and the the the
Commodity
second
linked
one was
notes.
yeah, exactly. And again, and the mechanism linking to the demand of the securitization again is again we try to model in the very simple way, perhaps making assumption that sometimes making making eh, maybe a heroic assumption on how uh, those uh, those those nodes and the behavior of financial sector may work. So again, this was also because, and you can also pointed out, those models are quite difficult to handle when the number of the equation and the number of
Yes.
the endogenous increases. So in a way, you can also you have some space. I will not say that there are impossible to handle when the number of equation increase. You do and there is literature and there are works in the literature that also have many more equation than our model. But at the same time, you have to be very smart in a way in when you try to insert something, when you try to put something, and you can either because if you try to modify one of the core mechanisms of this model, but then you may have some you may find in troubles. If you add something that is not really, I mean, for instance, well, for instance, the financial sector for us was really, I mean, the very basic financial sector. It was creating deposit to the public, etc., was really easy to model. The difficult part came when we tried to create those models because we were trying to substitute the direct the direct trading that was taking place between household in the very in the basic model of Godley, because basically the exchange rate mechanism in the godly was through the household. There was a changing, were changing their bills directly, and so you will have this because household were assumed as a kind of financial kind of household, something like this. And so when we try to substitute this mechanism, and we did incur in some difficulties. So I mean, we thought in this way. Another thing would have been to trying to modeling explicitly the portfolio decision of the banking system. So adding another behavioral Tobinesque equation, but for the banking sector. So of course we tried to do this, but we didn't have time, and then we decided for this. I think this was the first step of the modelization of the modification of the Godley's frameworks in order to moving closer to the stylized fact that are relevant to us. And so again, probably most of your argument will be dealt in this new version of the model, which again is still a working paper, but we are in the publication process. So we were really happy to. We will be very happy to share with you and with the broader community of the structuralist the structuralist
development bank economics.
The memory, yes, yeah. The acronym is quite is quite a piece to handle, but anyway, yeah. So those also would be my answers to your comments. But again, many thanks for spotting your the weakness of our exercise.
Okay, thank you, Giuliano. Now I think that we have the question of the audience. I have not much time because at 5 o'clock in Brazil I have another webinar. It's not of so interesting about economic theory, but more practical things on economic policy. But I think that we have question from Wallace Pereira. Daniel, can you bring? Yes. What do you think about the issue of debts in foreign currencies of non-financial companies given the exchange rate devaluation as economic policy strategy? Is the first question. And we have a question from Guilherme Peçanha. What were the lessons learned in conducting exchange and monetary policy from the Asian crisis of the 90s, and what should be the lessons for the emerging countries? Well, I think that we have time just for these two questions, and I ask for you to answer briefly because we are almost 2 hours of webinar. We're very close to the time limit.
May I ask the first, and then Giuliano, yes, you can answer the second, so we save a little bit of time about the debt, foreign debt in the non-financial sector. I think is a huge problem for implementing exchange rate policies for development, in the sense that at the end of the day, you creating a balance sheet effect when your non-financial sector is too in debt. And unfortunately, as we were talking before, non-financial sector has issued a lot of debt, and nowadays we haven't seen so much investment after the depreciation experience in the last years. And I was running before in my presentation, but one example to me, which is really relevant, is Mexico, that depreciated its level of currencies after 2014 on average by 15%, and it failed to increase investment, even though it increases export. So all the revenues from export are not translating in leakages to more investment, but actually are used to the payment of service. And there are some interesting data for the Mexican sector on the lending, on the banking lending used instead of investing to repay debt. and I will give the second answer to Giuliano.
So many thanks.
The question is on the screen.
Yeah. Okay. Yeah. I'm seeing right now. So many thanks to Guillermo. So yeah. So basically, for the Asian countries, the main lesson would be it can be summarized sum up in 2 points. Basically, try to hello.
Yes, I am here.
Okay. Okay. Yeah. No. Because for a moment there was some connectivity
I
issue.
think that your
Probably
signal sometimes had problems. I mean, I perfectly hear Lorenzo, but your sign sometimes had some fluctuations.
sometimes. Okay. Yeah. No. So it's definitely some my sign. Sorry for that. Yeah. I would be very brief. I mean, you can summarize the lesson from the Asian. Um, Well, I mean, it has again. This can be probably drawn from upon the experience of Chile probably during the Asian crisis of the 90s. But for instance, they even though they were in the haste of the first wave of financialization, they did had a they did have relatively reasonable, I would say, conduct in terms of the monetary policy and also the currency policy, and they did implemented some macroprudential policy in order to again to what we said in order to stabilize the currency, avoid excessive fluctuations, and at the same time trying to check the level of indebtedness. In particular, there was this measure called they introduced an obligatory stay of, if I recall well, of 1 year of the short-term capital, and again in order to try to check those to maintain to try to stabilize the value of the currency. So and something about this you also, and it is interesting because something like this happened in happened. There was a shift in the 2000. Chile was trying to shelter from the downturn of the global financial conditions through mainly through foreign exchange interventions, whilst Brazil did learn from Chile, did learn probably from its mistake of the 90s, and did try to apply some capital controls, and they not only achieve some results, but they also find they also manage to change the composition of capital flow or capital inflows from the short term towards the longer term ones. So there is an interesting study by Gallagher and I don't call it the name of the author in a book published a couple of years ago by a handbook published by Stiglitz. And it is interesting because it would seem that the Brazilian authorities at that point of time did learn from the mistake of the 90s, but the Chilean authorities simply forgot what happened in the early 90s and then applied the most market-based intervention, which were not successful at all. No, were partly successful, but not at the same degree of the Brazilian interventions.
Well, gentlemen, I think that we had to end this very interesting webinar right now. In half an hour, I have another conference to attend. But in the behalf of the Structuralist Development Macroeconomic Research Group, from which both of you make part, I acknowledge your presentation today for us. And I think that we can, in the future, have a very productive relation inside our group about these very interesting issues that you presented today. So if you want to say something just to say goodbye, it's okay.
Thank you very much for the invitation to the group and today for presenting our work. It was a great opportunity and we look forward to collaborate maybe in some models and to include your ideas in our baseline model, let's call it like this. And again, thank you for all the comments. They were really useful.
Right, and I take the opportunity to invite you both for the webinar next Wednesday of Professor Stephen Margling. That will be made just this one. And so you can make comments to questions to Professor Stephen Margling by the chat of our YouTube channel. This webinar is recorded, so it will be published in our YouTube channel, so you can share with your friends, with your colleagues, and with your professors. And I think that is an interesting contribution for the group. Right? So see you soon and take care of yourselves. COVID-19 is still free, so you have to take care. All right? Bye-bye, people. Many thanks for your presentation. Bye-bye.
Many thanks, Professor Orego.
Bye-bye.
See you. See you soon.
Bye-bye. Bye-bye.